Just right here is good, right? It's fine.
Yeah, if she doesn't need to see the slide, she has a copy of that. Recording.
Sweet.
All right. So back at it. So it didn't meet the current gap threshold. So this obviously kind of created a problem. Analysts were attempting to model these losses and figure out what the impact was going to be, and they didn't have a lot of relevant, reliable information to do so. So there was a clear failure of preparers to provide them with this information that they needed. And this can kind of play into the panic as well, because people sensed that something good was not happening, but they were unable to reliably quantify it. So, I mean, I think you can see how that would play into a panic mindset in the marketplace. So there was a regulatory response to this. In 2008, the FASB and ISAB created the Financial Crisis Advisory Group, realizing that in this, there's going to be a lot of issue areas that come to light when there's all this stress in the market. So they identified credit losses as an area that needed some work and a potential area to improve financial statements. And they noted that the current gap could result in delayed recognition of the losses and overstated assets, which is exactly what I had explained with the analysts anticipating it, but it not showing up. So now we're going to get into some current gap to kind of lay the framework.
So this is what the current gap says about receivables, any trade receivables, even your regular accounts receivable. What we did for you guys is to point out a lot of the differences between the current gap and the new gap. A lot of it is just centered around the codification. So our slides follow a numbering on your outline. So we'll go through what the current gap says and then what the update's going to say. So they're numbered on your outline and then as well in the slides.
Quotes you can take home if you
right.
So.
Right, that's just the best way to point out the differences. So first we're looking at current gap for receivables in 310.10.35. Current gap is going to require the recognition of loss when your two requirements are met. The first one being that it's probable, based on the information that's available, that our assets have been impaired, and then that we can actually estimate that loss. So right now, your credit losses are only recognized when that probability threshold is met. That's what a lot of the standard update centers around, is that probability threshold. Your losses from your receivables are only going to be accrued when those conditions are met. So you can have situations where an entity will be expecting that will have losses on our receivables, but since they know the customer, or let's say that that just certain conditions wouldn't let them reach that probable threshold, they're really misleading the readers of the financial statements, because it's not they're not expecting to collect on those receivables, but they're not writing them off their financials. Also, the current guidance doesn't specify how a creditor should determine the probability threshold. A lot of the new guidance gives out a lot of the new update gives guidance on how we're going to be how we're going to be determining whether or not we're going to be realizing that the receivables. And then that term probable has a range to it. Probable, obviously, the future events are likely to occur, so that's more than 50%. That's a pretty heavy threshold to meet. So that the new you'll see the new standard uses expected, which leaves a lot more room for interpretation on how reasonable we'll expect those receivables to occur. And then that term probable requires a lot of judgment. Obviously, you can't be certain whether or not a 51% threshold is met. So the new standard uses expected. That makes it a lot easier for firms to stand back and say, hey, it's not 100% that we're going to realize all these receivables, so let's tell our readers right now that we're not 100%, instead of trying to come up with a formula to get that probable threshold to get met. Again, more about the judgment. The new standard is going to have a lot of judgment necessary, but also you'll see the new standard gives a lot more guidance and detail on how we're going to properly use that judgment. And then this is just an example of a note to the financial statement for Citigroup in 2008 for how they determine their loan losses. So this goes into a lot of how they're evaluating their corporate portfolios on an individual basis, and they're using a lot of the same criteria like financial conditions, historical payment records, realizable value of any collateral they have to determine whether or not it's probable that they'll get their full investment back. So that term probable shows up a lot in this note. You're not going to see a lot of those terms in the future. This note to the financial statement would be very similar to a lot that you would see back in 2008. And going forward, they're going to be a lot different, where you're going to have institutions and firms explaining a lot more on how they came to their expected realizable value, and you're not going to see that term probable a lot more. I think actually in this financial statement alone, the term probable came up about 140 times.
Yeah, it was like 140 times.
So that's crazy.
Pages upon pages explaining.
Yeah. So you're not going to see that anymore. It's going to explain to the user a lot more how they came up with their allowance for credit losses. A little more on that. Would they have an increase of $2 billion in credit losses that year? Just because from year to year that'd be a lot. I mean, you wouldn't see as much if they had used expected instead of probable. But since they used that probable, it wasn't until 2008 until they were like, oh crap, we're gonna have all these credit losses, so let's put them on our balance sheet now, which amounted up to $2 billion.
And just one thing that's interesting on that last slide there. So this outlook for 2009 portion from their 10K. So they're saying that they're expecting credit losses pretty much, but they obviously can't recognize it yet because it hasn't met that probable threshold. And it's kind of funny that they're outlining the new standard before it even came to fruition. They're kind of a little foreshadowing there from 2008. So now we're going to talk about held to maturity debt securities and how those are accounted for. So investments in debt securities, their held to maturity are measured at amortized cost in the statement of financial position. The investment's impaired if the fair value is less than its cost. And here's just a large summary of the impairment indicators. And you can see there's a wide variety of things that you would take a look at: earnings performance, credit rating from agencies, business prospects, and then there's some more broad-based ones like adverse changes in regulatory, economic, and technological environment. So you can see there's a lot of quantitative and qualitative things that you would look at. And if an entity is more likely than not to sell the security and other than temporary impairment have occurred, so this is where it gets into the credit loss part. If the present value of cash flows is less than the amortized cost basis, they're going to go on to call this another temporary impairment and also call it a credit loss. It's kind of synonymous in this part of the guidance. And so when you're determining when this credit loss exists, you're going to use your best estimate of the present value of cash flows that are expected to be collected. I mean, this makes sense, but the question is, what is your best estimate? What is going to be collected? And this section of 320 for debt securities actually then, refers back to topic 310, which was the receivables, for how to calculate this credit loss. And that's where the reference to probable comes from with your debt securities, because they say when you're figuring out this present value of the cash flows, you have to predict what the cash flows are going to be. And how do you know what's going to qualify to be put into that model? So it refers you to that probable threshold once again. And this is a quote that stood out to me at the bottom here that the FASB straight up comes out and says it's usually difficult, even with hindsight, to identify any single event that made a particular loan uncollectible. I just kind of thought that was funny that they're quantifying this guidance, saying, oh, like, here's all this technical stuff on how to account for this, but just so you know, like, this is tough. It kind of gives you a lot of confidence in it, huh?
Okay, so this is what the current gap says about available for sale debt. So your investments in debt securities that are classified as available for sale, we're using the fair value to determine the financial position of those securities. That's not going to change with the new standard. You're still going to use fair value, but a little bit of how you're going to be writing off that debt is going to change. Currently, we use unrealized holding gains and losses that are going to not be in earnings and are going to be in other comprehensive income. We're going to keep that other comprehensive income requirement, but we're going to move away from the unrealized holding gains and losses into an allowance account that makes it a little easier to keep track of the status of our securities. This is the current journal entry for those gains and losses. We're still going to have other comprehensive income, except for that's going to be shown as an expense rather than a holding gain or loss.
Quick question. I don't know if you've dug into this, but are you going to be able to roll that up and present it net on the face of the financials and then just explain it in the footnotes?
Yeah, I believe it comes out in that. We didn't talk as much about the presentation and the balance sheet and stuff, but I believe it's
from what we read, it does seem like it's going to be netted out on the balance sheet.
So here's just a quick little video that gives you a break from listening to us talk that we thought kind of summed up this new standard pretty well in how to implement it. So before we get into telling you how to do it, we'll listen to someone else do it.
FASB has issued its final accounting standards update on credit losses for financial instruments. This will have a significant impact on your current processes, as this is the largest accounting change in banking history. The following 5 steps can help to ensure that your implementation plan is well documented and supported. The first step, determining proper pool segmentation, requires that each pool exhibit similar risk characteristics. Additionally, these pools should be as granular as possible while maintaining statistical relevance. Management should also evaluate these pools on a periodic basis to make sure they continue to exhibit similar risk characteristics. Step 2, calculating the life of each pool. This is a critical component of each methodology. Management will have more flexibility the more that they understand the life of each pool. Prepayment speeds and mortality rates are tools that management can use to calculate the life of each segment. Step 3, calculating your historical loss experience. This requires running multiple methodologies on each pool. Doing so will yield more accurate results and enhance your documentation. Additionally, running your historical loss experience over an economic cycle requires an iterative process over multiple periods. The next step, step 4, adjusting your historical loss experience for current and forecasted conditions. This requires an understanding of how your portfolio has performed over time relative to external and internal information. Management may revert to historical loss experience alone when a reasonable and supportable forecast cannot be created. Step 5, your documentation and disclosures will require more effort. Also, begin calculating your vintage disclosure today to ensure that your data and processes are adequate to meet the requirements. Begin now. Determine how you plan to execute.
Okay, so we'll expand a little bit more on what he was saying. But first he's going to go over an overview of what the new standard means.
So the objective of this is to provide more useful information, which we kind of touched on, obviously. It's going to be effective for fiscal years starting after December 15th, 2019 for SEC filers, and fiscal years after December 15th, 2020 for all other preparers. It's going to allow preparers to recognize losses when they're expected versus probable, and it's going to replace the current loss impairment methodology with a current expected credit loss model.
Okay, so first we'll go over the update on assets measured at amortized cost. A lot of what he was talking about in that video was the way we're going to use pooling on our assets to determine their probability, not their probability, their expectation of loss, using some characteristics that they point out. The scope for assets measured at amortized cost is going to be your held-to-maturity securities, your revenue transaction receivables, and your reinsurance receivables. So the first step in that is your initial measurement, and when we're going to measure it, we have a four-step process to do that. The first step in that process is to pool assets with similar risk characteristics. So those examples of those risk characteristics are going to be include term of the debt security, industry that you're in, credit scores and ratings of the different companies that have those securities, and then also the size of the firms. So we're going to create the valuation allowance account on these initial measurements, and then you'll see we're going to use the same criteria subsequently to change that allowance account. And using the pool just makes it easier to evaluate all of these securities. If you have a company like a bank or a company with a lot of receivables, you have tons of customers and tons of securities, and pulling them together with similar characteristics makes it easier to determine as a whole whether or not you're gonna realize your entire investment or not. The second step in this is to identify your appropriate measurement for each pool. So for each pool, depending on what type of securities there are, there's different measurements you can use, such as your discounted cash flows, your probability of loss, or probability of default, your loss rate, and then there's a bunch of other methods that firms come up with to really guide companies through the process of using these pools and characteristics. And then once you understand the current state of your securities, you use historical experience on each pool to adjust for that. So if you have a customer that you expect a credit loss, but in the past they've been, whether or not it's late or you eventually get that investment back, then you can use judgment on that. Again, I went into the last slide about how you adjust that historical loss experience, and then we're gonna continue each interim period to go over the same process. A lot of your pools are going to stay the same, but and characteristics, but you're just going to have to reevaluate at each period that allowance account and how it should be changed to reflect the current environment.
So available for sale securities. We were just talking about debt specifically. I mean, just to keep it simple, we kind of scoped out some things. But so under the new standard, an entity will determine whether a decline in fair value below the amortized cost basis has resulted in a credit loss. And so this will be through an allowance account, as Jack has mentioned before. And that's going to be limited, though, to the difference between the amortized cost over the fair value. And it'll be evaluated, reporting date. These securities aren't going to be pooled. They have to be evaluated individually still. And subsequent improvements to the allowance account will be recognized through net income. So if current conditions improve for the future and you expect that allowance to be less, you'll see that gain through net income, which we're going to go through an example where that happens. So now we're going to talk about the impact of what all of this means.
So the impact on accounts is going to be pretty similar to an impact that you would see in any major. I wouldn't call this a major reporting change, but a lot of your systems are going to change, and so the same kind of impact that you have in any other standards, you're going to have the same impact on these firms. There's not a lot of context, as well. There's not a lot of context in current standard that we're gonna be able to apply. You use pooling for some of your assets, but it's really gonna change a lot of the ways companies think about their customers and whether or not how similar and different they are to each other. And then again, we're gonna be evaluating a lot of subjective criteria. So that expected versus probable still stays pretty subjective based on individual circumstances, but so you're still going to use a lot more judgment. And then we think it's going to take these firms a lot of time initially to understand these new pools that they're going to be using and new systems that they're going to be using to pool these assets together. But in the long run, it's better for a lot the users of financial statements to actually understand the environment that these assets are in. And provide a lot more information. And then same thing with the impact on auditors. There's not a lot of current standard, no current context of the standard applied. And then auditors are going to be relying a lot on management explanations when they go into document what they see with a lot of these securities. So anything that uses subjective criteria in accounting practice is going to be pretty tough for auditors to audit, but like I said, you're just gonna have to. It's gonna take time initially, but as they understand their customers' business and as they understand how it changed their customers' accounting policies, it's gonna get smoother as time goes along.
One of our biggest problems with Baylor's audit this last year was due to all the events going on. We made an adjustment to our contributions receivable, and we don't book promises to give. We only book in, signed contract, donor contracts. And we've had a really small, obviously, contingency for that because we always collect them, right?
Yeah.
But just to be prudent, we wanted to increase it a little bit this year. And we don't know anything.
Yeah.
We don't know that this donor's, I'm not doing that, I'm not doing that.
Yeah.
You pretty much repeat me to the
slide.
That's what we're gonna
to your
kind
point.
of talk about.
Yeah, to your point, you have to either as an auditee or an auditor, you just have to get your ducks in a row in your method and show them what you're doing, and they still kept saying, "Well, how'd you come up with that percent? How'd you come up with that percent?"
Yeah.
Well, we have experience in this world, and we used a prudent, conservative method, and we increased it a little bit.
Right. You touched on that too. It's going to get a lot more conservative with companies too, because they don't have to meet that probable threshold. Other auditors are looking for is, hey, how much do you expect your losses to be on these receivables? So
we're going to have to let it ride a few years before we adjust it back. If everything comes up roses and we keep moving along, we're going to have to let it ride a few years before we can adjust it back.
Mm-hmm.
So we're going to talk about some challenges and kind of areas that standard might be lacking. I thought it was pretty interesting. The FASB published this summary of all the comment letters that they received. And they received like thousands of them because this has been in the works for years. And there's a clear kind of consensus over the majority of users of financial statements. So we're talking about mostly analysts, I would assume, is what they're referring to. So they wanted a model that would recognize all expected credit losses, so with no threshold. So they want it all as bad as it is right away, so they can have a good idea of, what is this firm facing? Is this potentially still a good investment or not from their perspective, or do we want to loan their money? Are they going to be viable in the future? So they want worst case scenario right away, all the time. On the other end of the spectrum, you have preparers, and they voiced an opinion that they would prefer recognition of only some of the expected credit losses, and they wanted to retain some sort of threshold, some word that's vague that they can say, oh, it didn't meet this probable or more likely than not or less likely than maybe, whatever it is. They expressed that they wanted something like that. So obviously the new standard is kind of a convergence of both of those, and not one whole party wins, even though I think this may lean a little bit more towards users. But I think what's going on here is preparers have a clear incentive in some cases to minimize the recognized losses. I mean, that looks bad for your company, and I don't know that the standard does anything to combat that incentive. So you change from probable to expected. It's still a vague, subjective term. And the evaluation of the criteria, it's almost every single same criteria that they mention in the evaluation of probable. So if you're looking at all the same data points, and when I say data points, they literally mention you may evaluate pretty much anything you could imagine. Like when we were talking about a few slides back on the health and maturity securities, they said any adverse changes in the political, economic, technological environment, and then some more quantitative factors such as like the market, credit ratings from agencies, and stuff like that. So to me, it seems this whole issue is pinned upon the point of the evaluation of subjective criteria, and we still have the same subjective criteria. We've just changed the word that we're throwing on top of that to some degree. And also the methods to compute are left to be decided by preparers. So they go into detail on, hey, here's a lot, and this might be a good idea to use this method in the implementation guidance on this, but you're not mandated to use any specific method. So as you said, you guys were calculating higher or a lower collectability of these donations. So now if you had an incentive, maybe you have a number in mind that you want, and you can pick now any of these methods, you can go in and evaluate any of these 100 of criteria and pick and choose and find the ones that you want to back into that number. I think there is still some room to do that. And with this large variety of factors to be evaluated, what does that do for comparability across industries and even within industries for similar preparers? Now, if one firm relies heavily on, we think there's an adverse political change, this is going to be detrimental to our business. I don't know if you guys saw it. Before leading up to the election, there would be an article, if Trump wins, the stock market's going to plummet 10%, and someone has their political view, and that's their view on the market, turn out with it. And then there's other ones, this is going to be the best thing ever to happen. So you can clearly see how someone can say, this is the criteria that I think is going to be most important, and we're putting the most weight on this. And now, what kind of comparability do you have between those two? You can end up with significantly different results. And also, one of the problems is the selection of the pooled assets. It's left up to the discretion of the firms. So once again, they're told to evaluate these characteristics to determine what's similarly related as far as risk goes, and that should be pulled together. Firms really want to, you can still kind of back into, we want these pulled together or not. And who's to say that they even know if it's going to be representative in the future? At the end of the day, you're still trying to predict the future, which is tough. And like I showed those few quotes from the FASB where they even come out and mention within the guidance, even with hindsight, it's hard to predict these events. So I still think that a lot of the challenges that were with the last standard are still going to be evident with this new one, and some of it seems like a little bit of a reaction to the financial crisis, and that we need to fix that, and this is going to stop it, but there's a lot of the same, I guess, challenges and tough areas to overcome in both of them. So we're going to go through an example real quick here of, this is from the implementation guidance on estimating a credit loss with the loss rate approach, which is one of the ones that they go through. Just to kind of walk you through so you can put it into practice. So Community Bank A, they're providing a 10-year loan to customers. They manage these loans on a collective basis with the similar risk characteristics, which we talked about with the pooling, So you have portfolio loans that are all similar. So they've compared a lot of historical information on financial assets and economic environment and the direction, and made their predictions. And they've also determined that their historical lifetime credit loss rate is going to be, for a 10-year period, 1.5% is what they've determined on an evaluation. All these factors, including prepayment history, among other things. And so now the next step is to determine if there needs to be any adjustments to this historical rate, what is going on currently that might make this historical rate irrelevant or maybe needing change, I guess. So now they're going to look at what factors affect the expected collectability. What are going to be the driving things behind this? And this is one of those places where there's, on some things like the U.S. Treasury security, there's going to be some clear factors that are going to be different from receivable from a customer or receivable from a large firm. So you have a lot of different factors to analyze. So they're going to determine that real estate values in the community and the unemployment rate are these two factors that they're going to key in on. And they've seen an increase in the unemployment and a decrease in real estate values. So they're going to expect on this analysis that they're thinking there's an additional decrease in real estate values coming, and the unemployment rate's only going to get worse in the next 2 years. So I bolded that word expects because that's the word of the day. So now they're going to have to go in and adjust the historical loss rate to show those differences and the effect of that. So they think a 10 basis point increase is going to be sufficient to capture this change in those factors that they thought were important. So they're going to change their loss rate to 1.65%. So as you can see, the idea, it makes a lot of sense. Okay, these things are going to make our loans worse, but it's a lot of subjective stuff, and it's kind of hard to nail with any certainty as to what's going to happen. So real quick, we'll go through this one about recognizing the write-offs and recoveries. And this is something we talked about, how it's going to flow through net income. So Bank K has a loan to an entity, and they've determined that this loan, because it's late, doesn't exhibit the similar risk characteristics. So now that no longer applies to that pool because it's fallen out of sharing all those characteristics. And it's because NNEL has filed for bankruptcy, so they're going to determine that the loan is uncollectible. So this doesn't have to do with as many estimates as I just want to show the write-off and recovery. But so they're going to increase their allowance for credit losses by expensing the difference from what's in the account now to the amount of the loan, and they're going to write off the loan. But now they've received a partial payment after the fact when they thought they wouldn't get anything, and they're going to, there's two ways to go about this, but in this example, in the implementation guys, I thought it was weird that they showed this one first, because the other method made more sense to me. But so they debited cash, credited the allowance account, and then at the end of the period, so they think their expected credit losses are going to be the same. At the end of the period, then they move that credit balance in the allowance account to reduce the credit loss expense. So that $50,000 cash that they received is going to be flowing through net income as you see it. And they also go on to mention at the end they could have just directly done that to the credit loss expense, which seems so much easier to me. But they wanted to explain the more complicated way first, I guess.
Okay, so just one more example for you guys. This is going to be an example where you have expected credit losses, but the expected non-payment is 0. So you're expecting your credit losses, but you're expecting to get the entire amount of your investment back. So A1 Corp is investing in U.S. Treasury securities with the intent to hold them to maturity. So we're going to record those securities on an amortized cost basis. So U.S. Treasury securities receive the highest credit rating by rating agencies, but the corporation management still believes that there's a possibility of default. So that's a question of, are you expecting a default, or is there a possibility? So that takes some judgment. But then this example also highlights the fact that even though you have a probability of default, you can use your historical data and your expectations to adjust whether or not you actually expect to get any losses from your investment. So they have, obviously the U.S. currency is routinely held by central banks. The United States can print its own currency. It's an international commerce and it's a reserve currency. So using that historical data and current conditions, you can make an explanation that we don't expect not to get any of our investment back, and so we're going to use our judgment to not record any credit losses on this in this instance.
Which I thought that one's particularly interesting. Once you think you have it figured out, okay, if we expect credit losses, we're going to need to recognize that. And then they say, no, if you expect it, but you have judgment reasons to believe it won't happen, you can avoid it. So there's 200 pages of little exceptions and specifics for certain types of assets, but we thought that one was kind of interesting to point out how complicated it can get and subjective. But so just to review, there was a clear need to address this issue with the FASB, and that probable threshold is going to be gone, wiped out. Expected losses now is the new term of the, I guess, important term. But like we talked about, it's still a lot of similar subjective criteria, so it's not exactly perfect. So we're going to go into some questions now because we know you guys have been paying attention and taking notes and you're ready to be quizzed.
We'll make them a little easy for you guys, though. So to start off, when the standard is going to go into effect. So what fiscal year start date does the standard go into effect for SEC filers? A, December 15, 2020. B, December 31st, 2020. C, December 15th, 2019. D, December 15th, 2018. Or E, January 1st, 2019. Actually, it's going to be C, the 15, 2019.
That'll be for all prepared SEC filers.
Yeah.
Is C. So you're close.
Any difference for public entities, do you know? I mean, Baylor's considered a public entity because we have debt conduit.
I'm sure.
So I think that would.
It would be A.
Fall
I'll go back and check it. I've got a spreadsheet where I'm supposed to track them.
Yeah.
You know what? I had the whole thing printed out somewhere, and honestly, I don't know where it went. I thought I put it down.
But I'm almost positive
I think
the
someone
answer would be
took it from
2020.
But we also have a May 31st year end. So we have a June 1st beginning of a year. So we generally get another year anyway. Maybe that's why I said June.
Yeah, so it'd be 2021.
Yeah, because because we're 12/31 doesn't matter to us.
Yeah.
It's June 1st of the next year, which generally gives us into the next year.
Yeah.
Yeah, I think the last group stole the whole 200.
That's fine.
Unless I lost it. But
We don't have this type of debt anyway, but I'm just applying it to kind of how we
Yeah.
handle our other receivables.
Mm-hmm. And then the next question: where will credit losses for debt securities held to maturity be recorded under the new standard? A, equity. B, net income. Or C, other comprehensive income. Anybody got any good guesses?
There's no wrong answers.
No. Well, there's two of them.
Other. See,
C. So it's actually
I'm quick.
so it's actually B, net income. For available for sale.
That counts for something.
For available for sale securities, it's gonna be other comprehensive income.
Okay.
But for all others, it's gonna be flowing to net income.
Oh, unrealized. That's what I was
Right,
looking
and
at.
then
Okay.
for the available for sale, if you ever get an improvement, then you put that into net income.
I'm not answering number 3.
I think they get it easier.
Yeah,
We thought we'd beat you down in the first few and then
they do.
end on a high note.
So question 3: when should credit losses be recognized under the new standard? When they become A,
Yes.
probable. B, more than likely. C, beyond a probable doubt. Or D, expected. It's actually D, expected. I didn't do that.
I was so confident. Yeah.
Under the old standard, it's going to be probable, but under the new standard, it's going to be expected. And then question 4: what method should an entity use to measure credit losses according to the new standard? A, discounted cash flow. B, loss rate. C, probable default. D, roll rate. E, aging schedule. Or F, no required method.
F, which is what I would make in this class.
That's right. You can use all of these different methods.
They mention all of them and they say, or any other
Yeah.
method that you
As
see.
long as
fit.
you-
So it's
Anything you
essentially
can
they have no
prove,
idea. You
Right.
If it's reasonable.
Right.
Yeah.
And then question 5: what is not specifically named as a criteria when establishing a pool of assets for the new standard? A, variance. B, industry. C, term. D, credit score, credit ratings, or E, size.
I don't even know. No, it's not.
Oh, sorry. It's
It was
going to be
A.
A, variance. All those other ones were listed as ways you could pool them, but
I think
variance.
we glossed over that. Well, that's it. I guess. Any questions? Anything else? Otherwise, I think we're done.
Good job. Appreciate it.
Thanks.
Yeah.
Thanks.
Thanks for hanging out.
Do you guys have any of that?
Oh, yeah. How do you stop this?
Oh, I got
So she can look at a minute of me trying to figure out your password.
Thank you. Thank you.
This is really gonna bother me. I don't know where I put that. That
Stack.
quote that I wanted to